Opendoor stock is currently trading at $5.51 as of today, Sunday, April 26, 2026. Because the market is closed today, this reflects the closing price and final activity from the most recent trading session on Friday, April 24, where the stock showed significant strength, surging 5.65% during the day. This price action is particularly striking because it comes at a time when most people have written off the iBuying model as a relic of a low interest rate environment that no longer exists. The reality, however, is that while the casual observer thinks Opendoor is just trying to survive, the institutional players are watching a massive internal transformation that is quietly decoupling the company's success from the raw direction of home prices. There is a common belief that Opendoor is a binary bet on interest rates, that if the Fed doesn't cut, the stock can't win. But the expectation that this company is a sitting duck for the next housing downturn is being challenged by its Opendoor 2.0 operating model. While the general market narrative focuses on the 30-year fixed mortgage rate hovering around 6.1 cents, Opendoor has been aggressively rebuilding its engine to prioritize inventory turnover over price appreciation. On Friday, we saw the stock break through its recent resistance levels on volume that suggests more than just retail day trading. When a stock in a beaten-down sector like digital real estate starts moving 5% to 6% in a single session without a massive headline, it usually means the smart money is front-running a fundamental shift before the next earnings report. The tension here lies in the gap between what the average user of a Fidelity trading platform sees, a stock that has struggled to stay above its 52-week lows, and what the technical data is telling us. We are seeing a compression in the bid-ask spreads for the homes they are buying, which is a direct result of their AI-driven pricing tools. The expectation was that as home prices softened, Opendoor's margins would collapse. The reality is that their latest acquisition cohorts are actually showing improved contribution margins. This is the secret sauce that the market hasn't fully priced in yet. They aren't just a real estate company, they are becoming a logistics and data company that happens to move houses. If you look at the recent trading volumes, institutional activity has been ticking up. We aren't just seeing the typical volatility associated with the Robinhood app or smaller retail-heavy investing sites. Instead, there is a steady accumulation happening. This suggests that the narrative is shifting from "will they go bankrupt" to "how big is the recovery?" For those using Interactive Brokers trading tools to track order flow, the uptick in mid-sized block trades suggests that professional fund managers are starting to nibble again. They are seeing a company that has narrowed its projected loss per share significantly, with some analysts now looking at a loss of only 12 cents for 2026, compared to much deeper cuts in previous years. For anyone involved in online investing, the question is always about the catalyst. Why now? The recent housing data shows a stabilization in transaction volumes. People have realized that the lock-in effect of low mortgage rates isn't going to last forever. Life events like marriages, divorces, and new jobs eventually force moves. Opendoor is positioning itself as the liquidity provider for that inevitable thaw. When you use a Fidelity mobile app or check your SoFi active investing account, you'll notice that Opendoor often moves in tandem with the broader homebuilder ETFs, but with a much higher beta. That's because while builders have to deal with labor and lumber, Opendoor only deals with the spread. Let's talk about the business model for a moment, because this is where the expectations versus reality dynamic is most visible. The old Opendoor, the one that lost billions, was trying to grow at all costs. They were buying anything that had four walls and a roof. Today's version, which they've dubbed Opendoor 2.0, is far more clinical. They are focusing on what they call high-velocity homes. These are properties that they can buy, refresh, and list within a very tight window. This reduces their exposure to market fluctuations. If the market drops 5% over 6 months, it doesn't hurt them as much if they only hold the house for 60 days. This shift towards capital-light or at least high-turnover real estate is what is driving the recent interest from Fidelity Wealth Management and other high-level advisory groups. The competitive landscape is also changing. Zillow exited the iBuying space years ago, leaving Opendoor as the dominant player in a category they essentially created. While competitors like OfferPad are still in the mix, Opendoor's scale gives it a data advantage that is hard to replicate. This is why when you look at investing sites or compare options on a SoFi trading platform, Opendoor stands out as the pure play for the future of digital transactions. They are aiming for 6,000 quarterly home acquisitions by the end of this year. To put that in perspective, that is a massive increase in volume that would allow them to spread their fixed costs over a much larger base, finally hitting that elusive adjusted net income profitability. Despite the optimism in the recent price action, we have to look at the risks. The macroeconomic pressure is still the elephant in the room. Even if Opendoor gets more efficient, a true freeze in the housing market, where nobody can buy because of affordability, would still starve them of the volume they need. This is the reality that keeps the stock at a forward price-to-sales multiple of under 1.0, while the rest of the industry averages much higher. The market is giving you a massive discount because it doesn't believe the turnaround is permanent.
It thinks this 5% jump is a dead cat bounce. I want to hear from you on this. Comment below how many shares of Opendoor you currently hold and what price you're waiting for to sell. The institutional side of the story is fascinating. If you track Fidelity IRAs or large pension fund filings, you see that these sticky investors haven't completely abandoned the ship. In fact, many are using the lower prices of the last few months to average down. They are looking at the company's balance sheet, which remains surprisingly robust given the trauma the sector has faced. They have enough cash to bridge the gap to 2026, which is when management expects to be adjusted net income positive. That's a huge milestone. In the world of online investment, the move from losing money to making a little bit of money is often where the largest share price gains occur. Looking ahead, the catalysts are clear. We have an earnings report coming up on May 7th, 2026. The market expects a loss of about 6 cents per share. If they come in at a loss of 4 cents, or if they show that their acquisition volume is ahead of schedule, the stock could easily retest the $7 or $8 levels. On the other hand, if they show that margins are being squeezed by rising labor costs for home renovations, we could see all of Friday's gains wiped out in an hour. This is a high-stakes game, and it's why people using a Robinhood app for fractional shares often find themselves on a roller coaster. The real story of Opendoor isn't about houses, it's about the friction of the American dream. Selling a home is still one of the most painful, expensive, and slow processes in modern life. Opendoor is betting that eventually, people will value their time and sanity more than the last 2% of equity. If they can prove that the model works at 6% mortgage rates, then when rates eventually do drop, the company won't just grow, it will explode. But that is a big if. The reality today is that the stock is a speculative play with improving fundamentals. It's a show-me story. The market has heard the promises before. Now it wants to see the numbers. For those of you managing your own individual brokerage accounts or utilizing Schwab Intelligent Portfolios, Opendoor represents a tactical way to play the housing recovery without the direct risk of owning physical property or the capital intensity of a homebuilder. It's a tech-heavy approach to an ancient industry. Whether you're using a SoFi robo-advisor or picking stocks manually on a Fidelity brokerage account, the key is understanding your own risk tolerance. Opendoor is not a widows and orphans stock. It is a volatile, aggressive bet on the digitization of the $40 trillion U.S. residential real estate market. In the final analysis, the gap between expectation and reality for Opendoor is closing. The expectation was that the company would be a casualty of the post-pandemic inflation spike. The reality is that they have survived, restructured, and are now growing their acquisition volume again. They've proven they can manage inventory in a declining market, which was the biggest fear investors had. Now they just need to prove they can scale that efficiency. As we watch the price move in these next few weeks leading up to earnings, keep an eye on the volume. If the volume continues to stay high on green days, it confirms that the smart money is finally moving back in. To wrap this up, the central insight here is that Opendoor is no longer the Wild West company it was in 2021. It is a leaner, more disciplined version of itself. The recent surge to $5.51 is a signal that the market is starting to recognize the progress of the Opendoor 2.0 model. We moved from a period of high expectations and low reality to a period where expectations were on the floor, and now the reality is beginning to climb. This creates a powerful setup for investors. The authoritative take is that while the macro environment is still tough, the micro-level execution at Opendoor is the best it has ever been. Whether you're using interactive brokers to short the rallies or Fidelity mutual funds to gain indirect exposure, you cannot ignore the momentum building here. The housing market is changing, and Opendoor is currently the lead architect of that change. Stay grounded, watch the data, and don't let the daily noise distract you from the long-term structural shift happening in how we buy and sell our homes. The authority of your investment decisions comes from seeing the reality before the rest of the market catches up to the new expectation. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.